So the central bank, the what called the NTB, Nigeria Treasury Bills auction on Wednesday, that auction was undersubscribed by close to 20 billion naira. That's quite very surprising. So where are the yields and what is the state of the fixed income market? Let's chase the yield around a little bit, chasing the yield curve. If you're in the market, you know how to chase the yield. It's like surfing on the seesaw shore. You know, it goes all the waves, then it goes all the way down. Then if you know how to ride the waves, then you just have a nice time. If you don't, then you get whacked down into the waters. Eromo Aziba, an investment analyst from Afrinvestors here this morning to help us chase the yield curve.
Good morning, Boston.
It's a nice chase, isn't it?
Yes, it's
quite
a chase.
When the yield is sweet and the market looks good. So, but last week, let's start from there. How did the central bank end up with about less than 20 billion, about 18.4 billion naira in shortfall in subscription to its treasury bills?
Well, yes. Over the
is it an appetite thing or is it a yield thing?
Over the past month, we've actually started to see yields trend higher. So considering developments across other global markets, we started to see investors price this into valuations in the market. So based on the rates that we could see in terms of the range of bids, we noticed that investors have started bidding at higher rates, and this could have been one of the reasons that we saw for that in the market.
On a subscription.
Yeah.
I'm just going to go straight to this. What should I watch more these days? It looks like a lot of stories are coming more from the outside, shows than from within. The stories about emerging markets still going into further flip-flops. There are stories this morning from Reuters that some sovereign funds are going to exit equity market. That is what Olufemi Awuyemi says as another layer to a challenging market outlook. Then you find the rate issue. Then you have the ECB in Brussels trying to balance out its quantitative easing. So all put in the basket, looks like both local and global macros and markets seem to portend what for our own yield curve?
Well, definitely. With these external factors that we've seen, it definitely plays a role in how our markets are shaped. Although the impact is more visible in the equity space, developments in these external factors. But when you come down to our local fixed income market, we know that about 50% of the market is dominated by the PFAs and the domestic players who usually aren't that active in terms of their trading activities, especially for the PFAs. So we might not necessarily see a significant reaction to any possible external risks. But on the other end of the curve, now we're faced with some sort of dilemma in terms of the CBN. We know as closer to the end of last year, there was already guidance that from this by the first half of the year or entering into the second half, we could possibly see a rate reduction and adoption of an easing monetary policy. But given the current situation where we have developed markets, rates trending high. I've seen the US Fed 2 rate hikes this year, also guidance from the ECB on seizing their quantitative easing plan. So looking at the fact that we're starting to see a hawkish stance from these global policymakers, it would be somewhat counterproductive for us to now decide to start reducing our own rates at this time, because we definitely need to keep our instruments attractive to attract the funds to come into the market.
We're caught in a crossfire here, in the manner of speaking. Our own debt restructuring program of the Buhari's administration, which was announced around September last year, seemed to be going on track during the Q4, then into the Q1. Then before we could grab that, things move with the Fed, with the ECB, and everyone else in between, and the emerging markets started getting punched. So why was that the reason why foreign investors or investors are asking for higher yield on our own assets?
Definitely. I mean, with a market like the US, where you have reduced risks in terms of their returns, a lot of foreign investors will be more comfortable with the returns that they would get from a developed market when rates are increased there, as opposed to investing here across frontier markets where there are higher risks. We have political risks as well that could also come into play. You have security. Considering all these risks, it became a safer option to invest in this developed market. But we started to notice a trend, especially across frontier markets, sub-Saharan Africa, Eurobond. Following the second rate hike by the US Fed, we saw generally bearish performance across frontier markets. We saw a lot of sell-offs across these markets. But over the past 2 weeks and even last week as well, we started to see some increased buying activity, which shows that investors still know that there's still that value in the market that investors can still take advantage of. They're still trading at attractive yields for investors to key into. But considering these risks that I mentioned, and also considering the fact that we're seeing rate hikes from developed, systemically important central banks, we expect investors to price this into our market, and that's what we are seeing shape out now.